Why is market liquidity important? Asset managers and retail investors care about liquidity because it affects the return on their investments. Illiquid securities cost more to buy and sell for less. Therefore, illiquidity eats into assets' returns. Thus, understanding how liquidity arises, builds, or vanishes, or identifying the market that offers the highest liquidity may be very important in portfolio choices and in trading strategies. Besides being a source of costs, trading can also be a source of risks for investors. Insofar as liquidity can vary over time in ways that are not perfectly predictable, it can heighten the risk engendered by the unpredictability of assets' fundamentals. So investors will require compensation not only for the expected trading costs associated with the liquidity, but also for the additional risks. For both reasons, illiquidity affects equilibrium prices, which must discount not only risky future cash flows generated by the asset, but also the future trading costs that its holders may incur and the associated risks. The need to compensate investors for illiquidity creates a link between the field of market microstructure and the field of asset pricing. But if illiquidity lowers securities prices, affecting the cost of capital for the issuers, then it will also affect these companies' day-to-day decisions on capital expenditure. The drying up of liquidity in several securities markets in the financial crisis of 2008 was associated with plunging asset prices and drastic reductions in securities issuance and in real investment by firms. And although these drops were largely a correction of previous overpricing and overinvestment, the illiquidity of securities markets amplified the effects of the revisions in fundamentals. This episode illustrates why policymakers take such a strong interest in the liquidity of securities markets and in how policies and regulations affect it. Investors, issuers, and policymakers naturally care not just about liquidity, but also about the speed of price discovery. This determines the amount of information that at any instant is embodied in the price of a security, and hence how reliable the price is as a reference point for managers' investment decisions. An informationally efficient price is also useful as a benchmark to evaluate the performance of the management of a firm, and for devising equity and option-based compensation schemes that provide the proper incentives to managers.